Adobe stock has lost more than a third of its value in 2026 alone. Shares closed at $247.90 on July 30th, down nearly 6% in a single session, sitting roughly 35% below where they started the year. No scandal triggered that drop. No factory fire, no data breach, no product recall. There was no company-specific disaster behind it at all. Just a continuation of a sell-off that ran through the entire year while the company kept beating Wall Street's own estimates. That's the part that should stop you. A company can post record numbers quarter after quarter and still watch investors walk out the door. That's exactly what's happening inside the building that makes Photoshop, Premiere, and Acrobat the software running underneath a huge share of everything you see on a screen. Since the start of 2026, Adobe has plunged more than a quarter of its value, and at its lowest point, the stock sat over 44% below its 52-week high. Goldman Sachs slapped a sell rating on the stock at $290, and HSBC cut its own target from $388 down to $302. A year earlier, this was a $417 stock. Now it trades in the low 200s. At today's price, Adobe trades at roughly 8.5 times its 2026 earnings estimate, well below the software industry's median of nearly 22 times. And it isn't as if the underlying business turned unprofitable. Gross margin still sits near 89%, and non-GAAP operating margin is projected at roughly 45% for the year, down only slightly from 46.2% the year before. Wall Street isn't pricing Adobe like a struggling company. It's pricing it like a company whose best days as a monopoly-style toll booth might already be behind it. The street itself is genuinely split on what that means. Of the analysts covering the stock, 8 rate it a buy and 4 rate it outperform, but 23 sit at hold, with 1 underperform and 4 sells, landing the mean price target near $270. That's not a stock everyone has given up on. It's a stock nobody agrees on anymore, and on Reddit and other retail platforms, sentiment tracking shows the same split turning sour, sliding from strongly bullish in January to a mixed, increasingly bearish mood by the middle of the year. So, what actually broke? Start with the fear driving the sell-off. Analysts point to generative AI tools from OpenAI, Midjourney, and a wave of newer competitors as a direct threat to Creative Cloud's dominance, alongside decelerating growth in the recurring revenue that funds the whole company. Bank of America went further, downgrading the stock on the argument that OpenAI's text-to-video and text-to-image tools, combined with collaborative platforms like Figma, are structurally capping how big Adobe can grow, and cut its price target down to $190. For 30 years, if you wanted to edit a photo or cut a video professionally, you paid Adobe. That toll booth is starting to look optional. A teenager with a laptop can now type a sentence into a chatbot and get an image that once required a design degree and a Creative Cloud login. Canva built an entire company on making design simple enough that nobody needed Adobe's learning curve in the first place, and Figma proved an entire generation of product teams could collaborate on design without ever opening Illustrator. Adobe isn't just fighting artificial intelligence, it's fighting a decade of competitors who quietly chipped away at the idea that professional creative work required professional Adobe software at all. Then came the part Adobe couldn't blame on artificial intelligence at all. Adobe switched to a subscription-based model back in 2012 for its flagship products, including Photoshop and Acrobat, and since then, most of the company's revenue has come from those recurring subscriptions. Back in June of 2024, the Federal Trade Commission sued Adobe, accusing the company of hiding early termination fees inside its most popular subscription plan and deliberately making it hard for customers to cancel. The government said Adobe buried those fees behind fine print and inconspicuous hyperlinks, sometimes worth hundreds of dollars, and made online cancellation a maze of pages, while phone cancellations meant getting passed between representatives. This March, Adobe finally settled. The company agreed to pay $75 million to the Department of Justice and provide another $75 million in free services to affected customers without admitting any wrongdoing. Going forward, Adobe now has to clearly disclose any termination fee before you sign up, remind you before a long free trial converts into a paid plan, and give you an actual easy way to cancel. Think about what that settlement actually confirms. A company that makes some of the most trusted creative software on earth had to be sued by its own government to make canceling a subscription simple. That's not an AI problem. That's a trust problem. And trust is the one thing a subscription business cannot survive losing. The case followed a similar pattern to the action by the FTC against Amazon over Prime cancellations, part of a broader regulatory crackdown on so-called dark patterns, the design tricks that make signing up effortless and canceling deliberately painful. And the scrutiny didn't stop at the US border. Around the same period, Britain's regulator opened its own probe into Adobe over cancellation fee concerns, even as Germany's cartel office cleared Adobe's planned acquisition of the marketing platform SEMrush in the first phase of its review. Adobe is simultaneously trying to expand through acquisition and defend itself from regulators on 2 continents over how it treats the customers it already has. On top of that, Adobe is facing legal exposure on a second front entirely. A class action lawsuit now alleges the company used pirated books to train its AI models, adding fresh legal and reputational risk on top of everything else. The same AI tools Adobe is racing to build to compete with OpenAI are now the subject of a lawsuit questioning how they were built in the first place. Then, in the middle of all of it, the man who built modern Adobe announced he was leaving. Shantanu Narayan, who had served as CEO for 18 years, told the board he would transition out of the role once a successor is named, and shares fell 7% in after-hours trading on the news. By that point, Adobe shares were already down nearly 23% for the year, more than 60% off their 2021 record, having fallen over 20% in each of the 2 years before that. Narayan took Adobe from a desktop software company selling boxed disks to a cloud subscription giant worth tens of billions. He's leaving at the exact moment investors are asking whether that entire subscription model has a ceiling that artificial intelligence just found. The board is now weighing 2 internal candidates, David Wadhwani, who runs Adobe's creativity and productivity business, and Anil Chakravarthy, who leads customer experience and previously served as CEO of Informatica, alongside outside contenders, with the search firm Heidrick & Struggles running the process. As of this recording, no successor has been named. Adobe is walking into the most disruptive stretch of its history without a permanent captain, trying to fend off regulators, AI competitors, and its own investors all at the same time. Here's what makes this genuinely complicated, because the easy version of this story, the one where Adobe is simply dying, isn't quite true either. The same quarter that triggered Narayan's announcement, Adobe reported revenue of $6.4 billion, up 12% year over year, beating analyst expectations on both the top and bottom line. Total recurring revenue exited that quarter at $26.1 billion. Adobe's freemium funnel is now converting a growing share of more than 850 million document and creative users into paying subscribers. and its AI-driven enterprise revenue grew 4 times over the past year, with the SEMrush deal alone adding roughly $480 million in recurring revenue. This isn't a company where customers are quietly walking away in droves. It's a company where the market has stopped believing today's growth guarantees tomorrow's and is pricing the stock for a future that hasn't arrived yet. Adobe is even sitting on a $25 billion share buyback plan, a bet by its own board that the market has overreacted and the shares are simply cheap. Adobe knows exactly where the threat is coming from and is spending accordingly. It deepened its partnership with NVIDIA to build the next generation of its Firefly AI models and agentic workflows, and made its core apps available directly inside ChatGPT rather than fighting OpenAI head-on everywhere at once. In late June, it acquired Topaz Labs, bringing industry-leading AI photo and video enhancement technology directly into Creative Cloud, an attempt to outbuild the independent AI tools, eating into its business instead of ignoring them. Whether any of that is enough is the $400 question Wall Street keeps asking every earnings call and getting a different answer to every time. So is Adobe collapsing? Not in the way a headline wants you to believe. Nobody's Creative Cloud subscription stopped working this morning, but something real did break this year. The assumption that Adobe's moat, decades of habit, industry standard file formats, a brand every design student grows up learning, was wide enough to survive a moment when a chatbot can generate in 10 seconds what used to take a trained professional an afternoon. Add a government lawsuit that proved the company was profiting off customers who couldn't figure out how to leave, and you get a stock market finally asking the question customers should have been asking for years. Not whether Adobe software still works, whether Adobe still deserves the loyalty it spent 30 years assuming it had earned for good. That's the story worth watching from here. Not the stock ticker day to day, but whether the next Adobe CEO can rebuild trust with the same urgency the company is currently throwing at artificial intelligence, because software you can replace with a better competitor. A reputation for making customers fight to leave once it's out there is a lot harder to patch with an update. Subscribe to the channel and like the video. There's a lot more coming.